All right. Now, that all being said, talking about the insurance tool a little bit, let's go to the insurance tool. Guillermo and I had a few emails back and forth today. I didn't get to answer your follow-up email. And Guillermo was talking about a friend who has shares of NVDA, and earnings are coming up on the 26th. Guillermo is a subscriber to PowerOptions, owner of the blueprint. Guillermo's friend is not. But he asked, with this situation, he said, my friend had a break even of about 144 before the situation. Now, after the deep seek, the stock is down, going to earnings. How could he protect it? And he gave me an opportunity. I showed him another one. And he said, well, no, but the cost basis was much lower. It was at 139 roughly. And, what could he do? Okay, well, Guillermo, the easiest thing to do is what you and I talked about before. Now, I showed you in the previous email, Guillermo, that I showed a married put position using your scenario. The stock was at 144. The put was at 145. And you saw the risk was different than you thought, because it said, oh, no, his cost basis was actually, my friend's cost basis was actually 139. Okay, but two things that you've talked about and we've commented before on, that you emailed me about and we talked about before, you could use right now to see that. Number one, we just talked about it. Go under the married put. Go under insurance. Plug in the cost base. Oh, I'm sorry. Let's start with the stock symbol correctly, Guillermo, shall we? NVDA. Put in a cost basis of 139. I'm going to leave the buy put month at all expirations. Let's go ahead and hit calculate. And what this tool just did is it showed me, okay, so we're currently, the stock's at 138.85. You have a current loss in the position based on the cost basis you're mentioning me now of 139. Okay, so this tool immediately just showed you what would your locked in profit be. Well, you're at a loss right now. So going out to the April 160, maybe a little bit too deep in the money, but the March 143, 21 days out in time, which would cross the earnings, doesn't have a locked in profit. It has a negative locked in profit, which means a risk of 4%. So if I had a gain of 8 or 10 or 12% on this position, and I went to the insurance tool, it showed me here that I have a gain of 8%. And, buying this put here would give me a locked in profit of 6%, meaning I'm guaranteed in the worst case scenario to still make 6%. But at the same time, I left my upside open. So in this scenario here, you just take a look. Let's go to profit and loss chart. You own shares of stock at 139. Now we're just using 100 shares, Guillermo, to keep the math simple. So it's a $13,900 investment per 100 shares. The March 7th, 21 days out, 143 put would cost about $10, $9.98. And so that would bring up our total cost basis to $14,897. But the put guarantees we're going to get $14,300 back. The maximum risk here is $598 or 4%. So what you've done here going into earnings on February 26th, you bought a shorter term put, still slightly in the money, following the rules in the married put technique, but you did this to give yourself some extra time, give yourself a little bit extra protection. You do raise the break even up to 148.98. That is true. But at the same time, you've set a floor where you're down 0.1%, almost break even at the position right now at 138.85. If the NVIDIA earnings are bad and the stock falls down to 134, 130, 125, doesn't perform, or the market doesn't react to its performance as well as you'd expect, the most you could lose is 4%. What happens if the stock does drop to 125? On the earnings date that you mentioned, 2/26, I believe you said. We'll take a look here and calculate that. Well, of course, we'd have a loss of about $1,400 on the stock from our purchase price of 139 to now 125. The put would gain a little bit more than half of that back. Kind of. Talk about that in a second. So your loss would only be 571, about close to the maximum loss here on the trade. But again, it can't go lower than that. Now, why did I say knock on wood? The current implied volatility of the 7th March 143 put is 0.5891. The market knows what we know, that earnings is coming up in 12 days from today, on February 26th. At that time, this 7th of March expiration is only about 10 days out in time. Really, less than that. It's about a week out in time, right? 2 days to the 28th, then another 7. Yeah, so 10 days out in time, 9 days, 10 days out in time. The implied volatility of this particular put option, as well as the particular call options in that near-term time frame, are going to be inflated because of this earnings event. They're going to be at the higher range of their implied volatility range. Why is that important? Let's check it out. When I want to see those values, whether I'm in the search, whether I'm in the option chain, whether I'm here in the profit and loss chart or custom spread tool, I'm going to go to that specific option. I'm going to go to research, and I'm going to go to option research. Now, the option research is not as bad as I thought with everything going on, but with the options research tool, it shows us all of the available data that we have for the option. Now, I know it can just be overwhelming, but some of the most important things I'm going to focus on is maybe some of the liquidity, the volume. Yeah, okay, bid, ask. I'm going to look at the last price. Current session high, current session low. Of course, last trade, it didn't trade today. It doesn't look like, last trade time it does say, I'm sorry, 214. Last price was 1001. My apologies. So it did trade right at the end of the day. But what's more important to me in this scenario is over here. The implied volatility of this option at midpoint is 0.5891. Now, it's not as bad as I thought, as I mentioned, but the implied volatility range of this option is at 42%. The total implied volatility of this option, since it's been released on the market, is 0.4569 to 0.7687. Let me jot that down real quick so I don't have to keep going back and forth. 0.7687. Why is that relevant? Why is that important? Because when we go back to the custom spread tool, we're going through earnings on February 26th. We're currently at a value of 0.5891. We're asking the system to tell us what is the potential theoretical value of my option, call or put, whatever strategy I'm trading, if the stock was trading at this price on this day or the day after the earnings, let's say on 2/27. Not going to be much change, a dollar change, but let's do that. Why it's important, whether you're doing a calendar spread, a calendar collar, any form of options trade when you have two different expirations, or you're looking at what would the option be at a time before my option expires. What you need to know is a best guess on the theoretical expected price of your option if the stock is trading at X on the date of Y. But in this scenario, we're talking about an earnings event, a known event with an unknown outcome. We are not at the highest implied volatility that we've seen for this option as just shown in the research tool. But I have to calculate. I have to expect that what if this did drop back down to that low level of 0.4569? After the earnings, the implied volatility of all options settle, and it goes back to its lower levels. How would that affect the trade? In this case, it only affected it by about $20. Well, it's so deep in the money, of course, in this scenario, but you have to account for that. If we were looking at more at the money at 138, these prices would change. Of course, it said, well, if the stock fell to 125, the implied volatility might actually go up. This might actually go up to 0.650, not a double point, Mike, just a 0.650. And how would that affect the trade? We'll gain about $10. Now, I know that looks small, but let's take a look at a different value. We were at 0.5869, I think it was, or something along those lines, right? Pretty close. Maybe a little bit higher. I think it was 1819. Let's go 0.5878. Okay, we're going to leave it at that. I'm not going to toggle numbers. Let's say the stock stayed right at the money in this scenario, if you were doing a long straddle or a long strangle. So again, Guillermo, let's just say it stays at 139. The day after the earnings on 2/27, implied volatility is at 0.5878. Well, we're going to expect some decay, of course, so it's going to be at 290.50. What if, for whatever reason, not likely to happen, the stock doesn't move, stays around this 139 range, but it goes back up to that high of 0.7687? Okay, now you're only at a loss of about 146.50. What if it does drop down below and goes to 0.40? Now you're at a loss of 436. See, now you're starting to see it become more important. I know that's a sidestep that I said I wasn't going to do a few moments ago, but it's important to realize that when you're doing any earnings trade. Now, this is an example of what you could do. This is an example of how the insurance tool can help you determine, in this case, you don't have any unrealized gain in this underlying security. If my cost basis was 120 going into earnings, I have a $19 gain, 15.7% unrealized gain. You see, I'm locking in profit here with these puts. That March 143 put would give me a 10% guaranteed profit going into earnings, meaning that we paid $12,000 for the stock, or $120. We're paying that same almost $10 for the put, which puts our cost basis up to about $130 per share, $13,000. But we're guaranteed to get 143 back. So even if the stock fell, stays at 139, drops to 136, drops to 125, we're guaranteed that we can force someone to buy our shares of stock at 143. So we're going to make $1,300. And if the stock shoots up to 150, 160, 161, we've left the upside open. Now, an alternative to this is, let's go back here. I'm going to stay in the insurance. So an alternative to this is what we've discussed before in various presentations. Your comment that you asked me is not something that I can answer directly because I'm not a registered investment advisor. But what you're asking me is, what is the best way to protect the position through earnings? Through buying puts. But in this scenario, when you don't have a gain in the underlying security, you're looking to minimize risk. We showed how you could do that to keep risk down to just 2, 3, 4% using some of those shorter term trades. Another approach you might consider, and I'm going to just link to a video real quick. We're going to head over to our YouTube channel, and that's not where I wanted to be. Sorry about that, folks. I paused the screen there. But what we want to do here is we're going to go to YouTube, and one of the videos that we have available, there we go. One of the videos that's available, of course, on our YouTube channel. Shoot. Hold on one second, folks. I hate when that does that. It's an automatic play. Let me just go ahead and bounce that off. Okay. And maybe let's just go here. I'm going to go to the webinars. I know you're not seeing that. Sorry about that, folks. It just did an automatic play. It's not supposed to do that when I'm on a webinar, but it still does. Options, concepts, no. Strategies. No, it's not where I'm looking for. And anyway, in any case, excuse me, what I was looking for there is one of the recent videos on what's called the hat trick for locking in gains. You can go to our YouTube channel, just look up the hat trick for locking in gains, Guillermo. What is that? Well, I'd use the insurance tool as a starting point, but I could also just use the custom spread tool and say, okay, why do I need to go in the money? Maybe I don't need to go in the money necessarily if I can find a good position. So what are we going to do with quote unquote good position? We're going to look for a cheaper put that's maybe slightly out of the money. The insurance tool will show you this in these scenarios, and then you can use that as a base to do it. And the hat trick for locking in gains videos will show you that. Again, we're going to keep NVDA at 139. And now we know we need to cross February 26th, but I don't want to be too close necessarily. March 7th might have been too close. I don't want to be too close because these are the options: February 28th, March 7th, March 14th, even the 21st, but I'm probably going to target the 21st 35 days out. I'll explain why in a moment. But what I'm going to look for here is, okay, let me buy a cheaper put. Let's go. I was at 139. He's at break even right. Oh, thank you, Kip. There we go. So we're in the custom spread tool now. And what I did is select the 21st of March. And as I mentioned, I'm going to use the 130 put at 560. Probably should do the 128, but nice round number. I'm going to use the 130 put. Now, remember, we showed that the March 7th 143 would still carry a risk with it of 4%. This is probably going to be higher at about 11%. Okay, 10.1%. That's where we are right now. Now that's a little bit higher than 4% as well, but I just paid $567 for a March 130 put to guarantee that in the worst case scenario, potentially on NVIDIA, I cannot lose more than 10%. If it drops down to 125, as we mentioned, if it drops down to 124, the most maximum loss you could take is 10%. How can we reduce that? Well, the obvious answer is to sell a call. So let's go back to our same expiration. We're going to go to March 21st. Stock's at 138.85-ish. Let me take a good number here. Oof, calls are all expensive, which means I don't want to say it. It means the market's betting on something. It doesn't mean the market's right all the time. But I want to use a nice round number, but I don't want to go as high. We could go as high as the 145. Let's go ahead and do that. We're going to sell the 145 strike. So where are we talking about here? Why am I calling it the hat trick for locking in gains? We talk about the hat trick. What are the three things we want to do? It's usually when you have a gain in the stock, Guillermo, and you're not currently sitting at break even. But the hat trick for locking in gains takes into account three goals. Number one, I want to lock in as much of my unrealized profit as possible within reason on a stock that's moved up in price before an earnings event, or just because I want to lock in the profit, like a trailing stop, but guaranteed, right? A stop order and a trailing stop are not guarantees. They're assumed insurance. If the stock gaps down below that overnight or through an earnings, you don't get the level that you set your stop or your trailing stop at. You get whatever the market is offering you. By buying the put, you're locking it in guaranteed. We saw that. We had some of those positions with that gain on NVIDIA, and we saw some of the put options which lock us into a 10%, 11% guaranteed return through earnings. So number one, I want to lock in profit. We're not locking in profit here. We're limiting it. Number two, usually when the stock moves up, how we phrase it is I want to lock in profit and I want to reward myself for picking the right stock. Okay, so I want to get some income on this position to reward myself for saying, hey, I picked the right stock, it moved up, I'm going to lock in some of that profit, but now I'm going to take a little bit extra. Goal number two. And then the final phase, the final goal, the hat trick, would be to leave the upside open, especially going into events such as earnings. What am I talking about here? The reward is I'm going to generate some income by selling a call. Not only to increase this potential locked-in profit or decrease this potential limited risk on the trade, but going through earnings, do I want a collar with a capped gain? Do I want a calendar collar if I use a put that was further out in time and sold a call near term? No, I want to leave this upside open. So leave the upside open, and that completes the hat trick for locking in gains, where I'm going to have a position that looks more like this. Unlimited upside, floored, limited risk, little bump up here due to extra premium, but leaving the upside open in case the stock exceeds my expectations. So, going back to the NVIDIA position, we can't lock in gains because we have no gains. We're setting a floor of about 10%. Again, probably higher than it normally would be, just because the event coming up and the implied volatilities are increased. But at the same time, let's take a look at that 145 call. It's going to be a midpoint of about 750 or so. Okay, so sorry. We're going to sell the call there. What did that just do? That paid essentially for the cost of the put. So why do I have zero risk? Well, because remember, my cost basis is 139. I paid for the price of the 130 put by selling the 145 call. That's true. We lowered the cost basis down to 13,717, whereas before it was at 14,400. Right? So we lowered that down, but the put is still at 130. So we're still risking 718 or 5.2%. We've just created a collar. We canceled half the risk on the position, about from 10.1 to 5.2%, by selling this and leaving us some upside. So if the stock gaps up above 145, 148, 150, we can make 5.7%. If it gaps down to 125, we're only going to lose 5.2%. And yes, at that point, we could still look to roll the call, but it's going to be expensive. But if the stock fell to 125, this call goes to zero, we can still manipulate this put option, start treating it as more of a married put position, even though we're in a shorter term expiration. We still have 25 days to go. But that's two goals. I'm going to take away from some of that. How do we leave the upside open? Although I only collected, essentially paid for this and collected $2 in premium, I'm going to look for a deeper out of the money call in case this exceeds my expectations. We're keeping the same expiration date. And, originally I usually look for about half. And these numbers are all wonky. You see it here as we go further out of the money. This one here goes 380 to 480, then back to 440 to 450. So they're jumping all around. But yeah, all the way up at the 160 strike is $3. So I'm going to do that. It's a wide spread, but that's okay. I'll explain why it's okay to have a wide spread in just a moment. And now this gives me that sort of collar position with unlimited upside, but the risk went back up to 7.3% because I had to pay $310 back into the position. And yes, in this case, that unlimited upside profit only occurs if the stock really exceeds my expectations, goes up to 170, 180, 190 or higher. But that's something to consider. That's what we would consider. Would I consider just buying a put and buying a 145 call, or buying the at the money 140 call and 140 put to create a strangle around the stock? Not necessarily, because then the extra cost might mitigate any gains if the stock moves up even 7, 8, or 10%, or moves down 7, 8, or 10% because of the extra costs. So that's something that you want to consider there as well. There we go. Let me do that. The strangle position. It doesn't really give you the profit and loss that you want. And now your risk is exceedingly higher because of the extra cost, even though you have a put in place. Okay. So take your time this weekend, Guillermo. Go to the YouTube channel. Check out the hat trick for locking in gains. If I have time tonight, I'll send you an email with a link to that. But those are our opinions on looking at locking in gains, which you don't have gains right now, but protecting the position and then maybe getting a little bit of oomph to get a lower risk on the position using what's income method number 6 in the blueprint. What I showed was essentially a bear call credit spread. Sold a call and bought a higher strike call, but in the context of owning the stock, you don't have to put up any margin because your broker just sees it as a covered call with an extra long call, and you're using that extra premium to help pay down the cost of the put going through earnings, so you still might have a relative lower risk based on what your friend's goals are for the risk and return. Would that standard collar make the most sense? Would buying the extra call to leave the upside open make the most sense? The break even here actually lowers from where you are right now down to 137.18 because of the extra premium. But if the stock does exceed your expectations and goes up to 150, 155, 160, 170, you're going to miss that upside. And it's going to cost a pretty penny to buy back that call. That's the trade-off. With the hat trick, or using income method number 6 in your blueprint, as it's described with the put in place, you leave the upside open, but if and only if the stock gaps up above that higher strike price. And as we saw, because you have to pay for it, it takes away from the mitigated risk you had here with just the put and the sold call. You go back up to about 7% in those scenarios. Owning stock, in my opinion, use the insurance tool first. See what's available there under married put. Look at the values. Once you see a married put or a put buy that looks like it matches what your goals are, then go ahead and link to the profit and loss chart. See what calls you might want to sell against that to do that, or use the hat trick for locking in gains. And again, go to a YouTube channel, use a search on our YouTube channel, just look up hat trick, 2 words, hat trick, and you'll see recent video. You'll see the recent video from about 3-4 weeks ago, I believe. No, a month and a half ago. My apologies, Guillermo. But then other ones there where we go more in depth.